Hello and welcome to Markets in Review, a special edition about what's going on in markets right now. Further to what I spoke about a couple of weeks back around the three things you need to remember with market conditions the way they are, is that you've got to look to the longer term. I am positive you've all seen the headlines with what's happened in what's been described now as Red October, which is US is having its worst month in basically since 2009. The ASX is down over 8.7% and still falling. Asian markets have been caught up with it as well. Europe is having a shocking time, etc., etc., etc. And then you get all the big headline figures saying about X amount of dollars has been taken off the market. You've got to look through that and look at the longer picture. And I think that's what we need to do, just put some perspective to where we currently sit. So let's have a look on what we always like to talk about here, which is total returns and the longer term view. And I think that needs to be your start point. So let's have a look at a more shorter period, because I know people now start to think in 3 to 5 years rather than what the last time I spoke about this, which was over 20. So let's have a look from the bottom of the last correction, which was at the back end of 2016, and to where we are now. And you can see even with Red October, as they're calling it, we are still well and truly up. And you can see on total returns, that pink line, that not only are we well and truly up, we are well ahead if you were putting yourself into cash even now. And that shows you why you need to be in markets. I can do it the same here. This is the S&P. And although the S&P doesn't have the kind of yield that we have here in Australia, you can see very clearly that on total return basis over the same period of time, they're still well and truly ahead. That also then brings to the next point of this, is that diversification, something we always talk about, becomes absolutely key in this point, because having your eggs in one basket, as we say, is never the right idea. And basically having just equities is the same principle. It's having all of your fund in one sector of the market rather than being diversified across. So here's a chart I always like to show, that instead of looking at it from a linear point of view of a risk profile, I'd rather show you as actually how the market sees it. So you can see very clearly, this is the ASX here with the equities, that it does grow quite strongly. You've also got property in there as well. But then you can see fixed income and cash is basically unavoidable and flatlining in that chart. But if you bring it back to a monthly basis, you can see why diversification is key. Because at the moment, your fixed income is weathering the volatility very, very well. And if you do have a percentage, even up to as much as 35% in those more defensive assets, they are offsetting and therefore managing to see through the volatility you're getting in your growth assets and your more risk assets. And over a longer term view, if you look at that and blend it out, it takes the volatility away and allows you to get through market sort of sessions like we're going through right now in a much bigger ease. So that's where we want to look at. Remember, longer term risk profile, total returns, and that events like what's happening right now are normal parts of market, and that's why diversification is key.